We're moving into a deflationary environment, is increasing by the month, especially because the Fed is railing against inflation when it is already coming down quite significantly. You know, it's interesting to listen to reports like Costco's and Home Depot's. Costco's basically saying, okay, we're going to have to clear inventory by cutting prices. They just come right out and say it, but the Fed's not incorporating those sorts of variables into its analysis.
The U.S. added 209,000 new jobs in June as hiring slowed amid signs the economy is cooling. It was the weakest gain since December 2020, lower than the 240,000 jobs economists had expected and lower than the 309,000 jobs added in May. But the increase was also the 30th consecutive month of job gains, and the unemployment rate ticked down to the historically low rate of 3.6%. The U.S. job market has remained robust despite the Federal Reserve's aggressive attempts to slow the economy and tamp down inflation with more than a year of interest rate hikes. The Fed chair, Jerome Powell, has indicated that the central bank will likely raise rates again this month after announcing a pause in June. Wages rose 4.4% in June from a year earlier. At an annual rate of 4%, U.S. inflation remains twice as high as the Fed's target, and some economists have raised fears that the central bank's steep rate hikes could trigger job losses and a recession. ARK Invest CEO Cathie Wood shares her view on fiscal policy, monetary policy, and her projection for new data that would be available in the coming weeks. Let us now get into the video. Also, don't forget to hit that like button, subscribe, and drop your comments below.
Fiscal policy to start. We are heading into the election year campaign season. And so what that means is we're probably going to experience gridlock, which is a good thing. It means there will be little to roil the markets, we think, during the next year from a fiscal policy point of view. So that's good. Monetary policy, we still have the Fed, interestingly, not mentioning money supply at all. Money supply is down roughly 5% on a year-over-year basis. Haven't heard a word out of the Fed on it. Maybe you have, but I haven't. It is still very focused on inflation and employment. Now, employment, we had so many indicators in the last week or so that there was something for everyone, bulls and bears. So today we got the non-farm payroll. It was below expectations at 209,000. Expectations were 230. But the important point was downward revisions, 110,000 jobs revised away over the last few months. So that made this quite a weak report from an employment point of view. But if you looked at average hourly earnings, they were a little better than expected. The Fed may not have liked that. And average work week was a little better than expected. So those probably all netted out to something a little weaker, not a lot weaker than expected. Now, we got all kinds of indicators. We got the ADP on Wednesday, employment, which was almost 500,000. And, of course, that roiled the market. In today's report, household employment, as you know, we focus on that because it captures more of the small businesses that are very important at turning points in terms of a leading indicator. Last month, those jobs were down, negative 310,000. But this month they bounced back, not all the way, but 273. In the report today, temporary employment was very weak, very, very weak. I rarely see it that weak, so I took note of that. And we also got the job openings report this week, and the number of job openings dropped by about 500,000. So again, as I said, something for everyone, including the Fed. The Fed seems to want to pay attention to the stronger numbers. So that is the employment side. On the inflation side, we see a year ago the commodity prices started falling pretty precipitously, and so now we're coming up against the comparison against that drop. So commodity prices, which had been down on a year-over-year basis by 20 to 30%, are now down roughly 12%. So again, we're comparing against declines last year. Now, if you look at the Bloomberg Commodity Price Index, it is still in a downtrend. So that is a leading indicator for inflation. The PPI reported this past month was up 1.1% on a year-over-year basis. So the Fed has a 2% target on a year-over-year basis. We've got two leading indicators that are well below that, commodity prices and the PPI, up only 1.1. If you look at the retail sales deflator, this is a number you kind of have to back into, and not many people pay attention to it. But it does belong to the retail sales report, which is a little more goods-oriented than services-oriented. But that is up only 0.2% on a year-over-year basis.
The latest figures from the Bureau of Labor Statistics come after the private sector reported a sharper than expected rise in hiring in June. Private employers added 497,000 new jobs last month, the private payroll supplier ADP reported on Thursday, well ahead of the 267,000 gain in May and much better than the 220,000 analysts had estimated. The near 500,000 rise was the largest monthly increase in over a year, with leisure and hospitality jobs accounting for the largest volume of hires. There are some other signs that the job market is cooling. The number of job vacancies is falling in the U.S., with 9.9 million open positions on the last day of May, 1.6 unfilled positions for each person counted as unemployed. That figure was down from the record 12 million open positions in March of last year, but is still higher than before the pandemic. Cathie Wood also shares her view on the rising number of bankruptcies and what it means for the economy.
Just the backdrop, though, away from these numbers, we're seeing rising bankruptcies. And a lot of the reason for this is because a lot of businesses take loans out on a floating rate basis. In fact, those are the only kinds of loans they can get. And the rates have gone up so much, 21-fold if you look at the Fed funds rate in a little more than a year. And a lot of businesses just cannot afford these loans anymore, and you're seeing the same with commercial real estate. Strategic defaults, left, right, and center, just can't put up with the interest rate increases and the empty office buildings. One of my dear friends, a doctor in one of the best parts of New York City, Madison Avenue, Midtown. She's being evicted, and so is everyone else in the building because it's only half full. And this used to be prime property. Maybe that's too New York specific, but I wouldn't be surprised to see the same thing happening in many other big cities around the world, maybe even the smaller ones, given the regional bank issues out there. Where else would we expect to see issues having to do with this massive increase in interest rates in such a short period of time? Well, we're learning now that in the private equity world, where you see a lot of collateralized loans, that there were $3 trillion. This is as of last August, but by that time, the Fed had already been jacking interest rates up by 75 basis points at a clip. $3 trillion in adjustable rate, unhedged loans of that sort. So I think underneath the surface out there, we're not hearing a lot about this, but that there is a lot of pain. And we also see that the KRE, which is the regional bank index, is just wallowing around where it was roughly during the regional bank crisis earlier this year. So no real recovery there either. And of course, one of the reasons is the biggest lenders to commercial real estate these days are not the big banks. They're not allowed to allocate that much risk to commercial real estate, but the regional banks. So we believe they are in quite a bit of under some stress. And that will continue if rates can continue to move up, because the incentive to move to money market funds or government-backed funds is only going to increase. I think when the Fed will shift its spots is when companies start responding to margin pressures, as consumers start saying, we are not paying higher prices. And we're seeing that more and more. Costco's report was a very good case in point. And at that point, margins will start to come down. And they've already started coming down. If you look at corporate profits, the corporate profits measure in the GDP accounts, which is it's called after-tax corporate profits adjusted for IVA and CCA. Those profits have already started rolling over. So companies are already beginning to feel a little bit of heat. We think that will intensify going forward, and that as a result, companies that have been hoarding labor, it had been very hard to get over a long period of time, hoarding labor, are probably going to let some of those employees go.
The Federal Reserve plans to keep hiking interest rates to stem inflation, which means an increase in corporate default rates is likely in the coming months. The corporate default rate rose in May, a sign that U.S. companies are grappling with higher interest rates that make it more expensive to refinance debt, as well as an uncertain economic outlook. There have been 41 defaults in the U.S. and 1 in Canada so far this year, the most in any region globally and more than double the same period in 2022, according to Moody's Investor Service. Earlier this week, Fed Chairman Jerome Powell said to expect more interest rate increases this year, albeit at a slower rate, until more progress is made on lowering inflation. Bankers and analysts say high interest rates are the biggest culprit of distress. Companies that are either in need of more liquidity or those that already have hefty debt loads in need of refinancing are faced with a high cost of new debt. The options often include distressed exchanges, which are when a company swaps its debt for another form of debt or repurchases the debt. Or in dire circumstances, a restructuring may take place in or out of court. Capital is much more expensive now, said Mohsen Megji, founding partner of restructuring and advisory firm M3 Partners. Look at the cost of debt. You could reasonably get debt financing for 4% to 6% at any point on average over the last 15 years. Now that cost of debt has gone up to 9% to 13%. Megji added that his firm has been particularly busy since the fourth quarter across numerous industries. While the most troubled companies have been affected recently, he expects companies with more financial stability to have issues refinancing due to high interest rates. Through June 22, there were 324 bankruptcy filings, not far behind the total of 374 in 2022. According to S&P Global Market Intelligence, there were more than 230 bankruptcy filings through April of this year, the highest rate for that period since 2010. Moody's expects the global default rate to rise to 4.6% by the end of the year, higher than the long-term average of 4.1%. That rate is projected to rise to 5% by April 2024 before beginning to ease. What is your view regarding these projections? Let us know in the comment section below. Also remember to show your support by hitting the like button, subscribing, and turning on notifications. Thanks for watching.